Welcome to Real Estate Radio Power Investing, an informative and engaging hour discussing everything you need to know about the world of real estate investing. Your host, Tom K. Wilson, provides you with insight and guidance from his years of experience as a successful real estate entrepreneur on how to buy, sell, finance, and invest in real estate, and much more. Now, here's your host for Real Estate Radio Power Investing, Tom K. Wilson.
Thanks for tuning in to our Real Estate Power Investing program, where we empower you with the education to maximize your investing success. We're broadcasting from the #1 business radio station in the San Francisco Bay Area, KDOW-AM 1220, the Wall Street Business Network. I'm Tom K. Wilson, your host for this weekly program on real estate investing. If you can't make the live show, you can catch our podcast on TomWilsonProperties.com or on iTunes or on YouTube. Today we have with us Chief Economist Fannie Mae, Dr. Doug Duncan, whom we'll introduce in just a moment. You can go to TomWilsonProperties.com for a lot of investor education information, white papers, topics about commercial and multifam investing, investing in houses. We provide turnkey houses for investors. We provide syndications for typically $50,000 a share, where you can own part of a large commercial or multifam project with a small amount of share investment, but you can only get access to most of those if you're signed up for our newsletter, so please go online and do that. Also, we welcome your questions and requests for future guests and topics, and we look forward to having your input on what things you'd like to see in the future. So we have today Dr. Doug Duncan, Chief Economist of Fannie Mae. Has been with Fannie Mae now, 10 years, Doug?
This is the ninth year.
Ninth year. And before that, 7 years as Chief Economist of Mortgage Bankers Association.
Yep.
And Doug is certainly, he has a very large staff that supports providing information to Fannie Mae to help them figure out how to steer the ship. And he's been ranked by some organizations as being one of the most accurate forecasters in the country. And on top of that, he's very easy to talk to and become a good friend. Welcome back to the program, Doug.
Thanks for having me. Good to be back.
So, Doug, tell our listeners we started a conversation probably 9 years ago, right at about the time of the crash, when the headlines were pointing fingers at the investors as being probably one of the biggest causes of the crash. And then as time went on, it was clear that there's a difference between speculators and investors. And so when you were out to speak to us at one point about that time frame, we said, hey, we feel like throwing out the babies with the wash, and I think the investors can actually be a solution and a benefit to society, not just a problem. And you saw the value in that and went back and championed it. And it takes a while to change a big ship, but when you had us, Bruce Norris and myself, back out there in December, had a nice audience for us that listened to our street experience input, and we both came away with a feeling that you've helped catalyst your organization to start considering a little bit easier money for investors.
Yeah, it's excuse me. It's been a little bit of a slog. The single-family investor category is not an area that the company has targeted particularly in the past, and so we still have things to learn. You've been helpful on that front. You probably saw that we did a securitization deal with Invitation Homes,
yep,
which was really a kind of a first experiment on one end of the spectrum of investors, that being a large institutional investor. So that's, the regulator is wanting to walk along with us and learn from that business how that fits in with the charter responsibilities of the organization. And we're continuing to work on that. The good news is that there has been a separation in the public's mind between what they would typically call as flippers, you call them speculators. They would kind of put that in the bad camp. And the fact that any market economy requires investors, and real estate's one asset class, it should be recognized investors provide value there as well. And so we're still working on exactly how it's appropriate for us to play in this space. But clearly, one of our responsibilities is the provision of affordable housing, whether it's rental or whether it's owned. We have a large apartment building business. I think we did about $55 billion in fundings for multifamily apartments this year, many of which are affordable. And we can also demonstrate that the single-family rentals has a significant component of it that is affordable. And so there's the question of whether or not we shouldn't broaden service into that space as well. So that's kind of walking along, like I said, with the regulator on that to make sure that what we do fits within our responsibilities.
That $55 billion for multifam, was that for 2016?
That was for 2016.
Okay. There were two primary areas I think we kind of focused on, and one was just let long-term investors have more loans. So we've discussed the possibility of moving from 10 to 20. Is that you think that has still has some potential of happening at some point?
I think it does. We've been taking a look at the distribution of the single-family rental properties that are out in the market today, and only about in terms of who the investors are, and only about 2% of those properties are owned by the large institutional investors. It's about 85% of it is investors that own 10 or less properties.
Right, makes sense.
And then the rest is in that middle category. So they're really sort of three different groups of investors, and we already have a lot of the 1 to 10 in our portfolio. A lot of that is sort of a side effect of people buying their first home, keeping that one as a rental when they move up to another one, and maybe acquiring 2 or 3 more.
Yep.
So we're in that space and have been in that space for a long time. The institutional investor piece, that's the Invitation Homes experiment to see how that plays. And then the middle piece will be the one that we were talking with you about, and where we'll have to put in a little more elbow grease to figure out what's an appropriate offering in that space that, like I said, that meets our charter responsibilities.
And indeed,
certainly the fixed rate funding is something that is of interest, to investors, and something that we do well.
And indeed, it seems to make sense for Fannie and Freddie to address the needs of the most number of borrowers and folks out there. But of course, those in the middle ground there that are not the institutional, but they're like myself and others, the maybe only 2% by number of borrowers, but as far as number of loans, it would skew that to a little bit higher percentage, I presume.
Yeah, I think our thought is the folks that own 25 to 100, or pick a number in there under 1,000, there's something like 8 or 9% of the market, and so in terms of the number of properties, it is an appreciable number of properties.
Let's talk now about one of the things Bruce and I proposed pretty strongly, and it wasn't just for investors, it was for anybody, that if we could address houses like we do in qualifying, like Fannie does in qualifying multifam loans, which Fannie's very dominant in the country, then with a debt service coverage ratio, then if the income would cover the loan, then it would be the number of defaults would drop to nil. And if they was a problem with the borrower, there'd be a lineup of investors ready to take over that loan. And we felt whether that was for an investor property or for an owner-occupant property, if it was rented or rentable for enough to give you a decent debt service coverage ratio, that would be really economically sound for society, Fannie Mae, and everyone.
Well, and that's what we want to do if and when we broaden out into that market, is make sure that it achieves the word sustainable, which is what everybody came back to after the crisis. It's one thing to put someone, whether it's an owner-occupant or an investor, into a property, but if they lose it subsequently, the damage to them is significant, and also more broadly to society. So making it sustainable, making a product offering which is for sustainable and affordable lending is really a key consideration for us.
And the nice part is that what makes sense from a cash flow standpoint for long-term hold investors also tends to be below median price houses, and therefore is providing housing for the affordability segment, which is part of Fannie's charter.
Yeah, and it's very clear that, particularly for young families, that's a large group of who the renters are that are in those
Yep.
homes.
Yep. Let's. Thanks again for catalysting and championing the cause for investors, mm-hmm. and working so diligently over these years to both have the visibility that we can be an asset, and to see if we can get some easier money for investors. Let's talk about home ownership. So we were at 9.5% roughly at the peak. The political pressures on Capitol Hill helped create that, because to get everyone in a home, and that created a problem that crashed. So now we're down to 63% or so. What do you think is the economically sound number in this era of new demographics? Is there
it's funny. Everybody's always looking for a specific number. I tend to give an answer, which, believe it or not, in some areas is controversial. But my view is the socially appropriate home ownership rate is the rate at which everyone who wants to buy and own a home and is economically capable of buying it and sustaining it owns a home. That's the right measure.
Yep, I like that. So what is that number? What's that number? I know you can't determine how many people want it, but you can figure out how many people can afford it, right?
Yeah, and it changes depending on the demographic profile, right? So, like, for example, I would expect the ownership rate to go up again, because the millennials are the largest population group we've ever had, and their aspiration to own a home is the same as all the prior generations. So we've gone into Gen X, which is a smaller population group. So part of the decline in the homeownership rate was the overshoot and the damage that was brought on by the foreclosure crisis.
Okay, we got to take we got to take a break. Let's continue on the subject of demographics and home ownership when we get back. We have Dr. Doug Duncan with us, Chief Economist of Fannie Mae. Stay with us. We'll be back in just a moment.
Welcome back to Real Estate Radio Power Investing. Streaming live on iHeart, TuneIn, and KDOW.biz. For more information on today's topic or guest, visit TomWilsonProperties.com. That's TomWilsonProperties.com. Again, your host for today's edition of Real Estate Radio Power Investing, Tom K. Wilson.
Fannie Mae Chief Economist Dr. Doug Duncan with us today. We're talking about the home ownership. So, Doug, you said that the right number is the right percent of ownership is for everyone that can afford it and who wants it can get one. And how the millennials are affecting things. Don't the records or surveys show that a lower percentage of millennials are interested in owning a home than older generations?
Actually, no. We've been surveying since 2010 on a monthly basis, mm-hmm. and in excess of 90% of millennials eventually want to own a house.
Wow, it's just a delayed effect, huh?
That's exactly right. Yeah, and now the good news is we have clear evidence that if you track the individual household as they age, as opposed to looking at all 30-year-olds, for example.
Okay.
What you see is the millennials are now moving into home ownership, and it's a statistically significant increase in the share of them that are moving to own a home.
So how does that compare in quantity to the boomers who are moving out?
Well, actually, the boomers aren't moving out. They're staying in their homes. They're 90% of them, plus I think it's actually about 93% say they want to age in place.
Wow.
And if you look at the home improvement construction data, it's the boomers that are driving that because they're remodeling their house. They want the kids to come home and bring the grandkids.
And that's without even including something like California Prop 13, where it's cheaper for us to remodel than to go move and swallow a bigger tax rate. Yeah, that's right. Exactly. Yeah. Okay. All right. Let's move to a new topic. Let's talk about trade. So let's talk about Trump's impact on the economy. First of all, what's your feeling about free trade? So those that certainly one economic thought or approach is that free markets are a good thing. Trump's approach seems to be, well, it is if it's fair trade, and it's not a free trade if other countries are putting tariffs on products. So how do you feel about being somewhat isolationist and just free trade within America versus worldwide free trade?
Yeah, so let's just talk for a second about theory, and then the detail of how you construct trade. Very few things you can get a consensus on among economists, but one of them is that free trade is a good thing for both parties.
Mm-hmm.
The problem with it is that in the negotiation, I think it was Milton Friedman that said a good free trade agreement can be constructed on one page of paper.
Mm-hmm.
And for example, I think the proposed Southeast Asian trade that treaty that was proposed was several thousand pages. That's a whole different standard. The biggest problem on the trade front is that the benefits and the costs are not evenly distributed within each of the trading partner countries. So there's the comparative advantage that each country has, they will play to in the trading arrangement, but the folks in the business that is not the comparative advantage are going to suffer from that. So it becomes an income and benefits distribution issue domestically for each of the two countries, and that's really, I think, what the discussion is about. So, like I said, economists would agree free trade and fair trade are both important and beneficial. But there is that side effect that has to be managed domestically in terms of distribution of benefits.
Mm-hmm. Okay.
One of the things I would say is I'm hopeful will be considered in the discussions with our neighbor countries, Mexico and Canada, is we have a privileged position in the world in that we get along very well with our neighbors.
Mm-hmm. Mm-hmm.
And part of that is based off of our trade relationships with them. We have 1,000 miles of border on one side and 1,500 to 2,000 miles of border on the other side, and no threat of an army ever coming across that border.
That is a unique position and situation. Let's continue that discussion when we get back with Dr. Doug Duncan, Chief Economist, Fannie Mae. Stay with us here on Real Estate Radio Power Investing on KDOW 1220 AM, the Wall Street Business Network.
Welcome back to Real Estate Radio Power Investing. Streaming live on iHeart, TuneIn, and KDOW.biz. For more information on today's topic or guest, visit TomWilsonProperties.com. That's TomWilsonProperties.com. Again, your host for today's edition of Real Estate Radio Power Investing, Tom K. Wilson.
So, Doug, if you were czar, what would you do about these trade agreements?
Well, fortunately, I'm neither interested nor expect to be a czar. The last one didn't fare that well, I think. There's nothing wrong with ensuring that the terms of trade are fair. I don't think anyone would disagree with that. The issue of tariffs, if you come to the issue of tariffs, that can be very destructive, as we can see if we go back to the Smoot-Hawley tariffs and their impact on global economic activity, leading to the Depression, really, or at least being a major contributor to that. So the tariff side of things, I think, is the troubling piece, and I think that's going to be the point of discussion. The border adjustment tax thing, I think, is a real difficult thing, and it's not clear to me that that's going to be successfully deployed.
Yeah, that's a tough one. Let's talk about deficit. Most of our annual budgets going for entitlements and debt service these days. We don't have a lot of flexibility of what money is left over. How do we ever get out of debt, or do we need to? As long as we are best looking horse outside the glue factory, as you like to say, can we keep kicking down the can down the road forever, or what do you think?
Well, the Keynes, John Maynard Keynes, is often cited as in his theories as the justification for running deficits. But one of the things people forget is that Keynes said that, yes, there could be a benefit from running them, but they should also be ended and repaid quickly. So that part always gets forgotten in Washington.
Well, it depends on definition of quickly, right?
Right. A lifetime would be good. The problem is that the greater the debt that you accumulate relative to the income that you're producing, so we look at the debt to GDP ratio,
Yep.
The greater that is, the less flexibility you have economically. And so if you go back to, people cite, well, Reagan ran all these deficits. Yeah, but our debt back then was much smaller relative to GDP. Than we have today. So it is the thing that worries me most about the United States' fiscal structure. And without reforming entitlements, it's going to be very difficult to get that back under control.
Yep. You still worried about Japan at, 250% debt to GDP?
Yeah, I guess a part of the issue there is that Japan is a wealthy country, but they're consuming it by paying on debt to themselves, and so there's no growth related to that. How long that can be sustained, I don't know, but it certainly is not an economy I would expect to show any significant growth anytime in the future.
Where do you think our deficit will be in 4 years, the end of
our deficit? Wow, that's a tough call.
Is it going to keep going up?
I'm sorry?
Is it going to keep going up?
I don't think so. I think there's an attitude in the population that says we actually have to get control of some of this.
Enough's enough.
It's not just us; it's also our children's future. And a growth rate of only 1.5%, which is roughly what we've had for the last 8 years, suggests that in the average lifetime of our children, they will not increase their income beyond what their parents had. And that's part of what led to the election of President Trump.
Yep. Wow. Dr. Doug Duncan with us today. Chief Economist Fannie Mae will be back in just a moment for some more of his input and thoughts about our economy and where we're headed.
Welcome back to Real Estate Radio Power Investing. Streaming live on iHeart, TuneIn, and KDOW.biz. For more information on today's topic or guest, visit TomWilsonProperties.com. That's TomWilsonProperties.com. Again, your host for today's edition of Real Estate Radio Power Investing, Tom K. Wilson.
Dr. Doug Duncan, Chief Economist Fannie Mae, with us today, talking about the economy. So, Doug, how do you feel about tax cut macroeconomics to generate revenue through economic stimulation?
Well, I am for low, simple tax structures, also with a broad base. So, in my view, if the base is broadened and marginal rates are lowered significantly, that you will get stronger growth, which ultimately will result in an increase in revenues.
Yep.
That's been tested and proven to be true. Usually what disguises that is that spending then increases faster than the revenue grows, and then people say, well, look, deficits went up. Mm-hmm. So I think there is an agreement among the House and the Senate leadership in each case that there needs to be tax reform. The nature of that, how they envision that, is somewhat different, though. So there's going to be, I think, an argument until the second half of the year over exactly how to do that. And underlying that discussion will be the question about whether it's, quote, revenue neutral or not.
Yep.
And I think the same thing is true on the corporate tax side. And those things, to me, need to be done either in concert with or before they change the terms to bring the capital back to the United States, that which is held offshore. Mm-hmm. Because if the business investment horizon and the consumer consumption horizon is not improved prior to that, you're likely simply to see that money come back and go into stock buybacks and things which don't generate additional economic output.
Mm-hmm. Mm-hmm. And we've seen some of that with the stimulation money since the crash, haven't we? A lot of money didn't go into stimulating the economy. It got held into the bank and reserves and buying stock and so forth.
Yeah, that's right.
Yeah, not productivity.
Right.
Is the let's talk about immigration. Immigration certainly has contributed to our population growth, and population growth, from a narrow, selfish perspective, a real estate investor, that's certainly contributed toward appreciation and demand for more product. What are we right now? Demand of 1.7 mil a year, new housing, something like that.
If we were building to meet the demographic growth of the country, we need a little bit over 1.5 million units, between 1.5 and 1.6 annually, to meet that growth in demand. And of course, we've got some catch up to do because household formation was very weak just after the crashes. So,
and we've only produced 1.2 mil last year worth of housing.
Yeah.
So we got about half mil, close to half mil short.
That's right.
And
so that's the biggest problem in the housing market today is actually the lack of supply. Mm-hmm. The immigration thing plays into that in a couple of different ways, and it can change in immigration, which could actually increase economic growth if it's targeted toward bringing to the country people who want to invest for opportunity or who come with skill sets that we're lacking. Mm-hmm. Mm-hmm. Those things can actually enhance economic growth and growth for everybody in the country. What has happened in the past has been, of course, a certain amount of immigration has been illegal, and therefore kind of goes into the underground economy. But we also structured immigration with more preferences toward family relationships, which weren't necessarily skill-based or entrepreneurial in nature.
Do you think it'd be better for economy if we take Australia or some other countries' approach where we have somewhat a credit-based immigration policy?
I think that encouraging the kind of people who come for the opportunity to create a life for themselves as opposed to simply taking advantage of the benefits that are provided in a society is going to be a more vibrant contribution to our overall melting pot. Mm-hmm. And after all, at one point, all of us were immigrants.
Yep.
And so we should have a natural inclination to try to use those policies to benefit everyone.
Yeah, it seems like maybe I don't know. I don't know if we now have a higher percentage of people coming here that don't bring as high a skills as we did before, but I think it's probably in all cases historically and now those who are coming here really want to be here. But,
yeah, that's right. I mean, and especially in a world with as much turmoil as there is at present, we are still the brightest beacon on the hill.
Yeah, it's a tough one, isn't it? You from a kind of supporting humanity and looking at our history and what created a good country. On one hand, you'd say, "Gosh, let's open the door for everyone," and yet we've got our own economic struggles, and if you bring in folks that are more of a drain on the economy than contributing, that creates a problem.
Yeah, that's absolutely right.
Yeah, it's hard to wrestle with. No easy answer for that.
That's correct.
Real quick, in about 30 seconds or so, let's talk about environment versus capital expansion. So we've got the two pipelines that Trump is pushing ahead that were held back over the last 8 years, and there are some that are concerned that it'll have a environmental negative impact, but it creates a lot of jobs. Got any thoughts about the pros and cons of that?
I think at the end of the day, all that will happen is there will be a shift of the pendulum back to the middle. Americans both want jobs and energy and some energy independence, but they also care about their environment. So I think we've swung way over to the environmental side of things. I think it'll come back toward the middle and get rebalanced.
Okay. All right. We'll be back on Real Estate Radio Power Investing with Dr. Doug Duncan, Chief Economist, Fannie Mae, for a wrap-up here. We'll ask him about, of course, interest rates and some more summary things about the economy. So stay with us on KDOW 1220 AM. We'll be right back.
Welcome back to Real Estate Radio Power Investing. Streaming live on iHeart, TuneIn, and KDOW.biz. For more information on today's topic or guest, visit TomWilsonProperties.com. That's TomWilsonProperties.com. Again, your host for today's edition of Real Estate Radio Power Investing, Tom K. Wilson.
Okay, here are the hot items that you tuned in today to listen to to hear what Doug's current prediction is. Last year, we asked you if you thought interest rates were more likely in 5 years to be less than 3% or over 5%. And you said, after a good pause, you said under 3%. So it means, there's still some downward pressure, and you think it's still potential that we could drop in rates?
It's possible. If we tip into a recession, that could happen. It's not our base forecast. Our base forecast is about 2% growth, very similar to last year. Rates at the end of the year pretty much where they are today, the 4.2, 4.3 for a 30-year fixed-rate mortgage.
Do you think it'll stay about the same? We won't have will we have a rate hike with the Fed?
Yeah, we'll have, we think, probably 2 rate hikes, but that's the short end of the curve.
Yep.
And the middle of the curve has come back down from the peak post-election. That's not surprising to us.
Do you think we'll have a recession next year or two?
It's not in our base forecast, but the question is, in the policy environment, what's the nature, the magnitude, and the sequencing of policy change? If we tighten trade and raise tariffs before we reform taxes and deregulate, we may well tip this, which is now getting to be a pretty old expansion, over into recession. I'd put that at maybe a 1 in 4 chance.
Okay. Hyperinflation?
It's very unlikely for the U.S. I think our monetary authority would intervene well before we got to that. But that's not to ignore the fact that it is a reality. All you have to do is take a look at Venezuela, and you'll see the impact of hyperinflation and how it destroys an economy and impoverishes its people. It's going on today.
We're going to keep the world reserve currency, or are we going to lose it?
No, we'll keep it. I don't see, I'd say at least another 25 years, unless we do something exceedingly foolish.
Again, partly because we're the better-looking horse outside the glue factory.
Absolutely. And, everybody was afraid of Japan in the 80s, and look at what's happened to them. They've been afraid of China in the first decade of the 2000s. They've clearly slowed down and have all kinds of issues in balancing their economy. Europe has had much less success in the post-crisis period than the U.S. has. I don't see whose currency would.
Real estate's still a good place to park assets?
People have always lived in a house or a building built on land somewhere close to where they work in a building built on land. I don't see that ever changing.
Okay. All right. Go to Fannie Mae's website, and a lot of what Doug's sharing today, he writes regularly on reports, and his staff does, and you can go on the website and see what those predictions are and what those thoughts and methodology and a lot of data. So it's
all free.
Yeah, very, very valuable, very free, and so go there. Doug, thanks so much for being with us again. Appreciate it very much. Go to TomWilsonProperties.com and look for also a lot of real estate investor education information. Sign up for the newsletter. It gives you access to a lot of products, commercial, multifam, and houses, many of which are only available if you sign up. And we always welcome your input. So thank you, Doug, very much for being with us. It's always a treat. Safe travels, my friend.
Thanks.
And remember, the only thing that matters is what you do next.
Thanks. Good to be with you.